Let's get started. The first 30 minutes after the New York Stock Exchange opens is generally pure chaos. You can call this amateur hour. Overnight orders, analyst upgrades and downgrades, retail traders piling in, and institutional flows all colliding at once. The result is extreme volatility. Take NASDAQ futures as an example. On days when a big tech company like Apple or Microsoft reports earnings, you will see an immediate surge in NQ futures at the open. Candles are fast, the ranges are wide, and if you catch it correctly, it can make your day in just minutes. But just as often, that first surge is a huge head fake that ends up reversing hard. Scalpers, they love this period because they grab points quickly. The key is using tight stops and smaller size because one wrong move can erase several winning trades. Another danger during this time is chasing breakouts too early. Many of the moves during the amateur hour are false signals that snap back just as quickly. In fact, many pro traders make their money fading these very moves. It's exciting, I know, but unless you have a scalper's mindset and strict discipline and you're fast, it's better to stand aside and trade when the pros do, which is typically between 10 a.m. and 11:30 a.m. Once the chaos of the open begins to settle, the market shows its hand. By 10 a.m. New York time, the initial imbalance between buyers and sellers is often resolved and the clear trends emerge. This is what I call the golden window. During this time, you may see the S&P, E-mini S&P establish support base after a volatile open, then steadily grind higher with strong institutional buying. Microsoft stock might stabilize after its earnings reaction and begin aligning with the index trend. This window is where professionals trade, and they find their best setups. It's less noisy, more directional, and offer higher probability trades. Strategies like trend continuation using VWAP or moving averages work particularly well here. If the broader trend is up, it's a time to enter with confidence. In fact, one of the most popular strategies among prop traders during the golden window is the opening range breakout. It is so widely used because it gives traders a structured way to take advantage of the volatility in the early session without simply guessing direction. Here's how it works. Traders, they mark out the high and low in the first 5 to 30 minutes after the open. I like 30 minutes. This defines the opening range. Once price breaks out of this range, traders look for momentum to carry the move forward. If you've got volume, that's even better. Imagine you're watching E-mini S&P. At 9:30 a.m., economic data hits, ES futures spike higher. Instead of jumping in right away, you wait until 10 a.m. to let the 30-minute range form. Now, you have a defined high and low. If the price breaks above that high with strong volume, you go long. Your target might be the next resistance level, perhaps 50 points higher, and your stop is just below the range low. Let's take a look at a real example. Here's a perfect example of the opening range breakout in the NASDAQ. So right here, we've got the market open, which is at 9:30 a.m. New York time. So we got the market open here. So we wait 30 minutes and we mark our ranges, which is the 10 a.m. candle here. So taking a look at the highs and lows of this period, you can see that this is the high during the first 30 minutes of trade, which is when we have the choppiest trading, an amateur hour. And you click this here, and that is the low from the 10, right before the 10 a.m. candle. This is a 5-minute chart of NASDAQ. You mark the high, you mark the low, and you look for a breakout of either one of these ranges. Now, you can also add in volume to confirm your trade. So we add in volume. You can see in the bottom here that, volume is pretty consistent on the 5-minute chart and volume is pretty high at the open. So the range breaks out to the upside. The stop is clear. The stop is right below. I would put it below this candle. If it drops back below this candle of the breakout, then you're wrong. Otherwise, ride the move and trail your stop accordingly. This is a very classic strategy that a lot of futures traders, prop traders use for trading the NASDAQ and the ES at the opening of the market. This strategy works especially well in futures because these markets are deep and liquid. Institutional flows often provide the fuel for continuation once the opening range is broken. That's why so many prop traders include the opening range breakout in their playbooks. It's simple, disciplined, and effective. Let's talk about the chop zone. By late morning, between 11:30 a.m. Eastern Time and 1:30 p.m. Eastern Time, volume starts to dry up. Many traders go to lunch, the market slows, London is off the desk. This is the chop zone, and exactly what it sounds like. Price action becomes sloppy, ranges tighten, and breakouts fail repeatedly. Amazon stock might grind higher in a narrow 50-cent range for hours. The E-mini NASDAQ might flicker up and down without conviction, producing nothing but whipsaws. Traders who try to force trades here often end up giving back their earlier gains. The best approach during this window is to avoid trading altogether. Protect your profits and conserve mental energy. If you absolutely must trade, which you really shouldn't, use a mean reversion approach. Fading moves back into the middle of the range, but keep your size small because the chop zone is where overtrading can ruin accounts. Sometimes the smartest move may be do nothing. Now, between 1:30 and 3 p.m. New York time, we have the momentum reload. After lunch, the institutions come back, and with them comes the volume and momentum. So between 1:30 and 3 p.m. is a time for the momentum reload. It's when the market often resumes the morning trend or sets a new course for the close. If bond yields fall in early afternoon, you might see the S&P 500 and Nasdaq futures surge as institutions rotate back into equities. If energy stocks start to lead, the Dow might take off. The strategy here is to align with the big flows. Look for a continuation of the morning trend if that's still intact. If not, wait for sector rotation and institutional repositioning. This is a great window to add to winning positions or catch a new move with volume confirmation. Smart money will often return, delivering strong directional trades and set the tone for the final part of the day, the closing bell rush, between 3 to 4 p.m. The last hour trading is known as the closing bell rush, and for good reason. Liquidity surges as funds rebalance portfolios, traders square positions, and day traders make the final move. This is when some of the biggest swings of the session happen. Tesla, which is oftentimes traded sideways all day, could finally break out in the last 30 minutes of trade. Thus, an S&P 500 might rally 20 or 30 points into the close as the volume spikes. The best approach here is a structured setup with clear targets. High volume breakouts, confirmed reversals, and swing entries for overnight holds all work well too. The closing bell rush rewards preparation and patience. So if you've been disciplined all day, this is your chance to capitalize. Timing is not just an afterthought in trading. It is a strategy in of itself. Future traders who understand the natural rhythm of the market, they put themselves in sync with the flows that actually move price. So what you want to do is scalp during amateur hour if you have skill and discipline. Focus on clean trends during the golden hour. Use strategies like the opening range breakout to capture momentum. Avoid the chop zone to protect your gains. And press your edge during the closing bell rush and finish the day strong when liquidity and opportunity are at their peak. So whether you're trading E-mini futures, CFDs on indices, or individual stocks, remember this: the clock is as important as the chart. If you align your trading with the right times of the day, your edge becomes sharper and your consistency improves. I'm Kathy Lee with BK Traders, and remember, the markets reward the prepared, and watching videos like this will get you prepared. So one of the best ways is to make sure that you subscribe to our channel for more strategies and insight so that you can approach trading with more confidence and clarity. Don't forget to check the description below for the links to our favorite prop trading firms and the latest discounts that we've arranged for our viewers. See you next video.